The housing market crash isn't coming, it's already here. While the media keeps talking about a soft landing, the data we're seeing tells a completely different story. We've been analyzing real estate markets for over 2 decades, and what we're witnessing right now reminds us of the early warning signs we saw back in 2006. The difference is, this time the crash is happening in slow motion, and most people don't even realize it's underway. But if you know what to look for, the signs are crystal clear. Let me walk you through 5 shocking indicators that prove we're already in the middle of a housing market crash. And I'm not talking about some theoretical future event. I'm talking about what's happening right now, today, in markets across America. The first sign that should have every homeowner and investor paying attention is the massive surge in housing inventory that's been building over the past year. According to the latest data from Realtor.com, national active listings jumped 28.9% year over year as of April 2025. That's nearly a 30% increase in just 1 year. But here's what makes this even more concerning. In states like California, inventory is up 36% year over year, with most counties seeing increases between 17% and 38%. Now, I know what some of you are thinking. More inventory is good, right? More choices for buyers. Well, not when it's happening this fast. When inventory surges like this, it means one thing. Sellers are flooding the market and buyers aren't keeping up. It's basic supply and demand, and right now, supply is overwhelming demand. We were just looking at data from major metropolitan areas, and what we found was eye-opening. Days on market have increased significantly across the board. Properties that used to sell in 2 weeks are now sitting for a month or more. In higher-priced segments, we're seeing inventory pile up like we haven't seen since 2008. But here's where it gets really interesting. This inventory surge isn't happening because of new construction flooding the market. It's happening because existing homeowners are trying to get out while they still can. They're seeing the writing on the wall, and they're making their move before things get worse. The second shocking sign is what's happening with price cuts, and this one should terrify anyone thinking about selling their home. In May 2025, 19.1% of home listings had price reductions according to Realtor.com data. That's nearly 1 in 5 homes for sale that had to cut their asking price. That's the highest share for any May since at least 2016. But it gets worse. This marks the 6th consecutive month of increasing price cuts. It's not a temporary blip. This is a sustained trend that's accelerating. In markets like Denver, over 30% of listings had price cuts. Phoenix saw similar numbers. Austin hit comparable levels. These aren't small markets. These are major metropolitan areas where millions of Americans live and invest. What's really telling is where these price cuts are happening most. The South and West are seeing the highest rates of price reductions. These are the same markets that saw the biggest price increases during the pandemic boom. Now, they're leading the way down. We've been tracking individual properties, and what we're seeing is sellers who listed their homes 6 months ago for $500,000 are now asking $450,000 or less. That's a 10% haircut, and many of these sellers are still not getting offers. The smart money is already recognizing that we're in a declining market, and they're pricing accordingly. The third sign that proves we're in a crash is the explosion in seller concessions. In the first quarter of 2025, 44.4% of home sales transactions included seller concessions, according to Redfin's latest report. That's up from 39.3% a year earlier. In some markets like Seattle, the rate hit 71%. 7 out of 10 sellers had to sweeten the deal just to get their home sold. Now, for those of you who've been in real estate for a while, you know what seller concessions really mean. They're a hidden price cut. When a seller agrees to pay $10,000 toward your closing costs or buys down your mortgage rate, that's $10,000 less they're netting from the sale. It's a price reduction disguised as a concession. The fact that nearly half of all transactions now include these concessions tells you everything you need to know about the balance of power in today's market. Sellers are desperate and buyers know it. This is exactly what we saw in the early stages of the 2008 crash. First came the inventory buildup, then the price cuts, then the concessions. We're following the same playbook. What's particularly concerning is that these concessions are happening even with mortgage rates above 6%. Normally, when rates are high, sellers have more pricing power because there are fewer buyers. But that's not what we're seeing. Instead, sellers are so motivated to get out that they're willing to pay buyers' costs just to close the deal. The fourth shocking sign is what's happening with foreclosures and mortgage delinquencies, and this one should worry every homeowner in America. According to Adam data, foreclosure filings in the first quarter of 2025 hit 93,953 properties, up 6% from the previous quarter and up 4% from a year earlier. That represents 1 in every 1,450 housing units with a foreclosure filing during the quarter. But here's the really scary part. Foreclosure starts in Q1 2025 totaled 68,794. Up 14% from the previous quarter and up 2% from a year ago. The trend is accelerating, not slowing down. States like Delaware, Florida, and Illinois are posting the highest foreclosure rates in the country. According to the Mortgage Bankers Association, the mortgage delinquency rate increased slightly in the first quarter of 2025, continuing an upward trend from the previous quarters. What's particularly troubling is that FHA and VA loan delinquencies are increasing faster than conventional loans. These are the loans that first-time buyers and veterans used to purchase homes. When these borrowers start defaulting, it's a sign that the foundation of the housing market is cracking. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. We've been tracking this data for months, and what we're seeing reminds us of 2007. Back then, we saw a gradual increase in delinquencies and foreclosures before the dam burst. The same pattern is emerging now. Homeowners who bought at the peak with minimal down payments are finding themselves underwater and unable to make their payments. The fifth and final sign that we're already in a housing market crash is the mortgage rate environment and its impact on affordability. According to Freddie Mac's primary mortgage market survey, the 30-year fixed mortgage rate is currently around 6.8%, and forecasts show it's staying at above 6% through 2026. But here's what most people don't understand. It's not just the rate level that matters, it's the impact on affordability. Since December 2021, housing affordability has dropped nearly 30% according to the National Association of Home Builders. We're now at affordability levels last seen in the late 1980s. Think about that for a minute. Despite all the economic growth and wage increases over the past 4 decades, buying a home is as difficult today as it was when Ronald Reagan was president. This affordability crisis is crushing buyer demand. Even though inventory is surging and sellers are cutting prices, buyers still can't afford to purchase homes. The median home price would need to fall significantly more just to get back to historical affordability levels. What's creating a perfect storm is the lock-in effect. Over 80% of current homeowners have mortgage rates at least 1 percentage point below current rates. Many have rates in the 2% to 3% range. These homeowners are essentially trapped in their current homes because trading up would mean doubling or tripling their monthly payment. The lock-in effect is artificially constraining supply in some segments while creating a glut in others. Move-up buyers can't move, so they're not selling their starter homes. But investors and second homeowners are selling because they don't have the same rate constraints. This is creating a bifurcated market where some price points are seeing massive inventory while others remain tight. Now, here's what all of this means for you as a homeowner or investor. If you're thinking about selling, the window is closing fast. Every month you wait, you're competing with more inventory and more desperate sellers. The data shows that price cuts are becoming more common and more severe. If you're thinking about buying, patience is your friend. The market is shifting in your favor, but it's happening gradually. Don't rush into a purchase thinking you need to buy before prices go up. The trend is clearly downward, and there will be better opportunities ahead. For investors, this environment requires extreme caution. The fundamentals that drove the pandemic boom, low rates, limited supply, and strong demand, have all reversed. Cash flow is becoming harder to achieve, and appreciation is no longer a given. Focus on markets with strong job growth and population increases, and make sure your numbers work at current rates and prices. The most important thing to understand is that this crash is different from 2008. We don't have the same level of risky lending or financial system instability, but we do have a severe affordability crisis and a fundamental mismatch between what homes cost and what buyers can afford. This crash will be slower but potentially just as significant in terms of price declines. The signs are all there if you know how to read them. Surging inventory up 28.9% year over year, widespread price cuts affecting nearly 20% of listings, desperate seller concessions in 44% of transactions, rising foreclosures with over 93,000 filings in Q1 alone, and an affordability crisis that's locking out an entire generation of buyers. This isn't speculation. This is what's happening right now in real estate markets across America. The question isn't whether we're in a housing market crash. The question is how much further we have to fall before we reach the bottom. Based on historical patterns and current fundamentals, we're likely in the early to middle stages of this correction. The smart money is already positioning for what's coming next. If you found this video interesting, please subscribe, share, and watch this one as well.